And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the Hump Day edition of The Real Investment Show. Danny Ratliff joining me this morning. I don't know if anything is important happening today that's going to move markets. I'm not sure, but we're going to talk about a few things. Actually, just teasing Nvidia reports after the bell today. Nvidia currently makes up 8% of the S&P 500 index. It's also one of the largest components in the technology sector. The technology sector makes up 30% of the index. If you're getting my drift here, whatever Nvidia announces today is going to move the overall market. That's going to be kind of the issue. So again, all eyes will really kind of be, today's market, regardless of what it does today. Again, a lot of this is pre-positioning relative to the earnings tonight because everybody knows that earnings announcement is going to move the whole market, good, bad, or indifferent. We'll see. But because of its size in both the S&P and in the tech sector itself, and the tech sector is part of the S&P, because of that weight, it's going to have a major impact on what happens to the markets tomorrow. So a good report will obviously be good for the markets. A not good report obviously won't be. One kind of interesting thing is Nvidia has been selling off here over the last few days. We've seen during this correctional process, we've seen a bit of a pullback here in Nvidia. So that's good because that kind of lets the market go into the earnings announcement with a little bit of the pressure valve already released off Nvidia. So if they come in with just an inline estimate or inline earnings report, or maybe just slightly better, doesn't knock the cover off the ball, maybe you don't see such a drastic downside move because a lot of that pressure has kind of already been released by traders. We'll see. Speaking of traders, retail investors have been vacant in this market as of late. We've seen very little retail buying over the course of the last week or so. So now, as we start to move into next week, that's Thanksgiving week. It's a holiday shortened week. Professional traders are going to be leaving the markets really pretty much after today. Once Nvidia is done, professional traders are going to go on vacation. So it'll be pretty much inmates running the asylum through next week. Typically, the last 2 weeks of November, so next week, Thanksgiving week, and the week after, tend to be okay, tend to have positive returns in the market. So we get through this little bit of slop here in the market itself. Don't be surprised if we start to see a little bit of elevation kind of next week. Again, we'll see what happens after the bell today with earnings. But I want to talk a little bit about the market. So here's what you need to know before the bell today. So a couple of things is that right now the market's down about 3% from the peak, the S&P. Now the Nasdaq's down a little bit more. We're down about 5% from the peak, kind of peak to trough on those two indexes right now. And I'm getting a lot of emails like, oh my gosh, when's the selling going to end? It's just every day, it's just this relentless selling pressure, media headlines, market sell off again, it's a relentless sell off, these type of things. We had the strongest 6-month rally in the index that we've seen since like 1990. It was a very relentless 6-month rally. So corrections are part of that. Yes, Virginia, drawdowns happen in bull markets. So this is just kind of what's happening in the markets right now. And we've talked about this before. This is why we talk about managing risk, taking profits. Markets are going up. It's like, Lance, markets are going up. Why are you saying take profits? This is why. Because you're going to get these corrections that occur. And again, as I said just a few weeks ago, I said, when we get a correction in the markets, it's going to feel a lot worse than it actually is. This is a 3% drawdown, peak to trough. It's not been that big of a deal. But again, if you kind of listen to the media, it's like, oh my gosh, the world's coming to an end. And I'm getting lots of emails about, portfolio positioning, these type of things. This is how markets work. And as we touched on a little, so yesterday we, Two Dads on Money, if you haven't seen the video, we spent a good bit of time yesterday talking about technical analysis. And so that's on the website now. But this is why technical analysis is important, is that things occur in the markets, markets start creating a narrative. And then when that narrative falls apart, everything kind of goes with it. And we've seen so many of these narratives over the last few years, dollar debasement, Jeff Gundlach and other people are like, oh, interest rates are going to 6%. That hasn't happened. And so these are the things that, kind of get based into the markets. So people start buying these assets, right? They buy gold, they buy, Bitcoin, they buy stocks and all these type of things, and things occur in the markets. And I'm gonna give you a really good example of this. So this is a chart of Bitcoin over the last 3 years. And this is I'm not making a case for or against Bitcoin. This is not the point. What I'm laying out here is just you have to be careful of these narratives that occur because they eventually fall apart. Here's what I'm talking about. So about 2 years ago, we were about 40,000. So in January of 2024, so just 2 years ago, we were at about 40,000 on Bitcoin. And at that point, this is when Michael Saylor starts coming out like, I'm buying Bitcoin, and we're gonna do all this Bitcoin treasury thing. And the Fed is gonna start cutting rates. And so we start kind of building in this premise of more rate cuts. And then we bring ETFs to the market. So now we provide institutional access to Bitcoin. And so we have this very large push that occurs in Bitcoin because of all this liquidity rush into this based on the narratives that effectively we're going to cut Fed policy, Fed policy is going to ease, that, we've got this dollar debasement issue going on, whatever it is, whatever your favorite narrative was, this is what caused that. And what now has occurred is that we've seen this fairly sharp drawdown. Again, still within a bullish trend, right? Nothing terrible has gone wrong with this, but if you kind of listen to the media, it's like, oh my gosh, why is this all going on? And the reason I'm just using Bitcoin here is because there's a good narrative behind Bitcoin, but this is a very high proxy to the NASDAQ. So what you see going on the NASDAQ with AI stocks, et cetera, very highly correlated. The NASDAQ is very highly correlated to Bitcoin. So these kind of run together in terms of liquidity. So again, we've seen this very, very nice trending rise in the index, and while we've had this very nice trending rise, right? So now we've had this reversal, we've had this break of support, and what the ETFs provided, and this was a warning that we gave you before, is saying ETFs are great, but they also provide institutions a way to short liquidity. So when you had this push in Bitcoin with ETFs and everybody piling into ETFs, you gave institutions the ability to short Bitcoin. So now you've got this issue of institutions using the ETFs to hedge Bitcoin positions, cryptocurrency positions, whatever it is, or to basically take advantage of the markets. And so this is leading to larger, more volatile drawdowns. And this is the same case that's happening within the NASDAQ, the S&P as well. Again, this is just an example of liquidity push. But this is why, as I said yesterday, this is why technicals are so important to pay attention to. You've had a very clear sell signal about a month and a half ago in Bitcoin. It gives you a very strong MACD sell signal. We were very overbought at that point. So again, this bit of a correction right now is not really surprising. It's just part of the cycle. So again, this is why it's important to pay attention to what's going on with markets. Be careful of these narratives, because the narratives eventually, all narratives, 100% of them, always break. The narratives that are put out by the markets are never long lasting, because the markets adapt to the narrative and then change. And once they change, then you've got to come up with a new narrative. So just be careful, again, what's going on in the markets right now. This is just a normal process correction from bringing down very overbought conditions after a very, very strong rally over the last few months. This will end, and then you'll have your next opportunity to invest. But this is why risk management that we talk about here on the show all the time is so very important for your money. Okay. Wrap that up. That's what you need to know before the bell this morning. We're going to come back, pick up with Danny Ratliff. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Yeah, speaking of that economic summit's coming up in January, and again, it's going to be really good this year. We've got institutional investors from BlackRock coming to talk about artificial intelligence. We've got one of the founders from DFDV coming in they trade on the NASDAQ, talking about cryptocurrency and development. So there's some really, really good stuff that we're going to be covering, but those tickets are going to sell very quickly. We've got very limited seating at the Royal Sonesta Hotel. It's a really great layout. We're going to have a lot of opportunities. But make sure you get your tickets early and get those funded, because the price will go up as we get closer to the event itself. And again, seating is very limited, so make sure you get your seats now. So a couple of things, just talking about, kind of the markets themselves. Again, it's just, this, and again, so just going through a second ago, is that this pullback is just a pullback. We're just having a normal correction within the markets. And again, if you looked at all the emails I'm getting from people, it's like we're in the 15% drawdown. And I warned you about this previously. I said, when you have very complacent markets, small pullbacks are very unnerving. And again, you've had a 3% correction in the markets. We're not even in a 5% correction yet, right? We're not even in a what you would determine a really drawdown, right? This is just a wiggle. But you would think from some of the emails that I'm getting that we're in the midst of a major bear market crash. So it's important to keep things in perspective. And this is why we talk so much about, taking profits, rebalancing risk, doing all these type of nonsense things, because when you have these type of opportunities, and this is an opportunity, right? There's a lot of stocks that are getting really beaten up here that are going to give you a good opportunity to buy them cheaper and add them to your portfolio. And this is what we're looking for. We want opportunities to add stuff to portfolios. And, when you have a bit of a pullback, a minor pullback in, technology stocks, it's like, all of a sudden the AI trade's over. As I said yesterday, way too early to be calling that, right? We're very young in this whole AI cycle. It's going to end, no doubt. We are over-investing, no doubt. All those concerns are very valid, and it's all going to end, but it's not going to end now. We're way early in this thing. So there's still a lot of potential play here. And again, we run a chart. This is one of the most important charts that we publish every week in our weekly newsletter. If you don't subscribe to our weekly newsletter, you're probably missing out on the best thing that we produce all week. And because this goes through a lot of important data that is at the bottom of the newsletter in particular. And one of those charts is what we call our risk range report. And what this risk range report does is it looks at the month-end price of the market itself, and then it compares it to its normal range. So in other words, it looks at technology as an example, just to pick a sector, right? So how does technology normally trade within a given month? And based on its beta volatility, how much does it normally move up and down a month? We then measure that current price action. So since the end of the month through the first week of the month, how is that sector performing relative to its normal beta volatility? Is it moving more? Is it moving less? And that can provide us kind of what's going on within the sectors and the risk. But you can bring this chart up, Brent. On the far right-hand side, though, is what I want you to look at. There's a column on the far right-hand side labeled bullish or bearish. That column on the far right-hand side is when that's a major moving average crossover on a weekly basis. And at the beginning of this year, we had about 10 sectors that were trading bearishly still. Last year, more than half of them were bearish because we were kind of coming out of the 2022 kind of drawdown in the markets where the vast majority of these were bearish. So you had these bearish crossovers on a weekly basis on most sectors and markets. That has been recovering since then. And we are now down to the only sector that's now still trading bearishly on a crossover basis is staples. And over the last 6 months, we've turned a lot of these sectors and markets into bull markets. Now, the important thing about this is that this is weekly analysis, so this occurs very slowly over time. When you have the vast majority of markets trading on bullish crossovers, you are not near a major bear market. You need to start seeing these. And again, this is why this chart is one of the most important charts that we publish every week. And it's in the weekly, we only publish it in the weekly newsletter and on simplevisor.com. But when you start seeing those bearish crossovers start to increase, right? Instead of right now they're reducing, which says we're in a bull market. So you want to participate in this bull market. But when you start seeing those individual sectors and markets begin to reverse and go back into a bearish crossover, that's your indication that the market's getting closer to a bearish drawdown. That's what got us out of the markets in late 2021, going into 2022, because we started seeing the increase in these bearish crossovers, and we wrote about it then. So again, if you don't subscribe to our weekly newsletter, you're probably missing out on some of the most important stuff that we produce every week. But again, there's a lot of analysis in that newsletter every week to help you manage your money better. So anyway, the point is, I just want you to be careful we're having a wiggle in the markets right now. There's nothing drastic going on. Yes, volatility has picked up a bit, but there's nothing dramatic that's happening. And again, if you saw some of these emails, kind of the panic behind some of these emails I'm getting, you'd kind of understand why I'm just relaying this to you. You may be going, Lance, I agree with you. It's everything's fine. I'm looking to buy. That's fantastic. I'm just saying, if you took a look at the volume of the emails I'm getting, concerned about where this market's going, and of course I'm getting everybody, the most bearish commentary out there. People are sending it to me. It's like, did you see this guy on this YouTube channel? Did you see this article this guy wrote? Yeah, I've seen it all, and most of them are going to be wrong. So just be a little bit cautious with kind of where you're getting your information from. Anyway, that's it for that. Good morning, Danny. How are you?
Hey, good morning. Doing well.
Good. So and now speaking of emails, I got a very interesting email, and this was something that, we discussed a lot in the past, and we talk about, kind of making decisions that are important. And one of the things that we deal with a lot as a firm is we deal with, because we live in Houston, we're kind of in the energy capital of the world. So we're going through a cycle right now where we're starting to see energy companies starting to lay off individuals, starting to cut back on employment because of, productivity increases through AI, whatever the reasonings are, right? We are seeing layoffs kind of pick up from a lot of the energy majors. And the energy majors are one of the last few remaining relics in the world that actually have pension plans. And those have gone the way of the dinosaur for the most part. But this brings up a really good conversation, because this may very much affect you, is that if you have a pension and it comes time for you to retire, you are presented with a very important decision, which is the decision to take a lump sum or to take the annuity from the company. And there's a lot of factors, and a lot of people are like, oh, it's just simple. I just take the pension, right? I'm going to get a monthly payout for the rest of my life. Be careful with that, because there's a lot of factors that go into influencing that decision. And it's not just how you take it. It's not just the lump sum itself or just the pension. It's also how you take the pension, right? Do you do just on yourself? Do you do it, joint survivor? There's a lot of questions that are going to come down to that. What do you expect about, and if you're 2 or 3 or 4 years away from retirement, part of your decision is going to come down to the direction of interest rates, because the direction of interest rates are also going to influence your lump sum. We saw a lot when interest rates were falling and the Fed was keeping interest rates near zero. We saw a lot of people delaying retirement because the drop in interest rates was boosting their lump sum payout. When that reversed, we saw a lot of people rush to the exit, because now interest rates are going up, and that's impacting their lump sum payout again. So again, interest rate decisions make an important impact on this. Net unrealized appreciation, if you have company stock, this is also another big consideration. So there's a lot of things to go into. So I brought Danny in today to kind of talk about, some of the decision-making process behind whether or not you take a lump sum or you take a pension.
Yeah, and we're seeing a lot more of this right now. Obviously, you just mentioned consolidation in energy companies. A lot of these companies do offer those pensions. There's still many others. I fear, though, in 10 or 15 years, Lance, we may not be having this discussion.
Yeah.
I mean,
no,
pensions
they're going the way of the dinosaur.
Yeah, they're extinct. And they are a fantastic tool. And if you're blessed to have one of these, I think you need to do your due diligence and make sure you're utilizing it properly. And so I think with anything, we need to make a pros and cons list. There's a cost benefit analysis that you need to determine, okay, exactly how this works, and then what is your intent for the funds. And so really there's the way I view this, there's a couple options, but the main two options are you either take the lump sum, you move it to an IRA, or you take the annuity from the pension. Now, the annuity can take shape in many different forms. It could be on single life. It can be on a joint life. Lance alluded to that. And a lot of times you can also do it a period certain, meaning it'll be life and period certain. They will pay you a higher amount, but depending on how long that period certain is, meaning it's like a term. So picture term insurance, right? You're going to have it for a specific period of time. Now, after that
Whether
time,
you're
it
alive
goes
or
away.
dead.
Yeah.
Yeah. I mean,
But-
if you take it for 10 years certain, somebody's getting paid for 10 years, but after that, it's over.
Well, if it's a life and period certain, you will get paid for the rest of your life, but your beneficiary won't get any
Right.
payments after, let's say it's a 10-year period certain. Year 11, you pass, there is nothing to your heirs. Now, same thing when we think about a pension, and this is why most people say, well, I'm not even going to think about this. We're just going to roll it over. This is easy. We're going to put it in an IRA. Or some may take the funds and just say, I'll pay the taxes. I would highly discourage you from doing that. Do not have them write a check directly to you. Have them write it to your custodian, wherever your IRA is, and then make decisions from there, because then we can be very strategic with the funds. But you need to determine, I think, if we knew a lot of things, it would really help. Like, what does your longevity look like? What do you have any guaranteed income outside of Social Security? What does that look like, and what maybe buckets or lack of do we need to fill within your financial plan? So when we begin to break this down, it really helps to understand, and then also, one other thing, what does a legacy intent look like? Because if you have a legacy intent, you could get one payment. And if you're on single or joint life, if you're single and you pass away, if it's a joint life, you're in a car wreck, both of you pass, there's nothing left for the kids, for your heirs, beneficiaries, whoever that may be. And so that is why most people end up taking the lump sum. However, there are many times, and there's also things you can do from there that we can talk about here in a bit that will kind of alleviate that. So give you an example. Had a client, single, not married, said, I'm going to take the pension, all right? I'm not worried about beneficiaries. I'm not worried about heirs. So I want to go ahead and get the most bang for your buck out of this. And saying that if I live a long time, this will be great. So, well, that's probably true. However, one thing that pension doesn't have is a cost of living adjustment. So now, while that guaranteed income is really nice, at some point, without that cost of living adjustment, it's just not going to be, not getting as much bang for your buck in 10, 20, 30 years. Now, we could look at that same scenario where single has a decent amount of savings already, but he said, you know what? I want to look at the best options out there. They go ahead and they roll the funds over. So maybe I do have a little bit, maybe I'm more charitably inclined. And they go out and say, well, can I find an annuity from an insurance company on a secondary market that's going to be similar? So at least there's something left if I'm not here. Because I've worked hard. I want to make sure that, what I've done so far, somebody realizes that. Now, same scenario where you could say, hey, I've got kids. Mm-hmm. I want to take the lump sum. I have plenty of income coming in. I'm okay. And this is another thing. So part of this is behavioral. And nobody ever talks about this aspect. You have to know yourself. Like, I've had clients that have plenty of money, but they are scared to death of the market. And for them, in a way, having that guaranteed income actually frees them up psychologically to invest in the market.
Right.
And that's not everybody, but you need to know yourself. So oh, you know what? I feel really good. I've got enough income that I have met all of my expenses. Everything else is icing on the cake. I've done a good job saving. So now it allows them to actually go out and invest the funds. When we looked at it long term, it really actually bolstered what their kids would receive when they pass. And that was really important to them. But the other thing it also does, if you take that lump sum, it frees up for Roth conversions. We can start to become strategic with it. Can we, if you're young enough, can we go ahead and convert? Can we draw down the account enough before you reach 75 or 73, depending on how old you are, when that required minimum distribution age will be, to give you some flexibility? I mean, we have this tax code right now. The way I view this, and Lance, you can correct me if you think I'm wrong, but I would envision that you have this tax code until at least 2029, if not 2030. And at some point, that pendulum will swing, and we will likely see higher taxes some point in the future. So if you're having this discussion right now and thinking about this, run an analysis. Make sure you start to really capture what's important to you. Is it legacy intent? Is it guaranteed income? What is the best way to go about receiving that guaranteed income? Because if you did roll it over and you did it into an insurance like the annuity where you create your own, you're going to have some more flexibility. The pro with that would be if you want the guaranteed income, then you actually can, if you pass, your beneficiaries still receive whatever the balance of the account is. And then you can attach other bells and whistles associated with it, potentially long-term care riders. There's a number of things that you can do. But I don't want to pigeonhole into one specific scenario, but going back, and Lance is tired of me saying this, but you need a financial plan. You need to run an analysis. And, unfortunately, there's all these calculators, and they do it in a vacuum, where they say, okay, here's what the plan looks like. Here's what happens if you roll it over. And here's what, assuming in a percentage of return, what this looks like and when it becomes better to do one or the other. But I think it goes much deeper than that. And understanding how this works within your financial plan, understanding the drawdowns that you will eventually see, and what the overall intent is long term, and the flexibility that you may or may not need depending on the assets that you have saved. Right. So don't look at this in just that small piece.
Yeah, and to that, we get a lot of questions in chat, about the poll question. So the poll question came from an email I got this week. Asking this specific issue. The poll question is, if you had $700,000, would you take it as a lump sum or an annuity? And a lot of people in chat is like, well, most pensions aren't that much. Most pensions are like $25,000. That if you've worked for, and again, we're in the energy capital of the market, so of the world, right? So it is not abnormal for us to see individuals that have worked for a major oil company for 20 or 30 years retire with seven-figure lump sums. It's not uncommon at all.
Not at all. We see it on a daily basis.
Yeah. So, yeah, it's just, and these are guys that were working out, and we're not talking about major executives of these companies either. We're talking about guys that were working out in the oil fields for 30 years, right? And, they were just, working in offices or whatever, and just basically they get very well taken care of at these oil companies. So, again, this is not an uncommon thing at all. But regardless of the pension size, I think the important thing to come back to is what Danny was saying, is that if it's $25,000 as your pension, that's a pretty easy decision, right? You take the lump sum, you go invest it in the markets, and go on with your life.
That $25,000 is going to give you how much every month, right?
Right. Yeah.
Probably very little.
Exactly. So, but if it's a sizable pension amount, then the decision: do I take the lump sum, or do I take the annuity? Goes back to really, your longevity risk, your legacy estate risk, those type of things. And again, a lot of people assume, well, I'll just take the money because I invest it in the markets and make more money in the markets. Be careful with that, because I saw a lot of people do that in 1998, 1999. And then they lost half their lump sum in the markets or more.
Or even early 2000s.
Yeah. Saw the same thing in 2007, 2008. So, there's a lot of people think they can manage their own money. It's easy in a bull market. Bull markets make us all think we're smarter than we are. So, got to be careful. There's a lot of decision factors. It's not just math and taxes, Peter. There's a lot of factors that go into your decision-making process, and it should not be something taken lightly, because unfortunately you get one shot at this decision and you've got to make the right decision. You can't come back and fix it later.
No, once it's done, it's done.
Yeah.
And I would highly recommend, if you are married, do not do single life. I mean, it may be very short-lived, But I mean, you need to actually think about this as a just like Social Security. You need to think about it for both of you. What does longevity look on both sides? So if you're married, what is your spouse? What's that look like? How old are their parents? Is everybody in good health? If you're not in very good health, you don't have very much longevity. Do you really want to take that pension? You may be better off taking the lump sum in that instance and saying, hey, I'm not going to draw it all down anyways, and the remainder will go to my heirs or wherever I'd like it to go. And a lot of good questions in the chat. And Lance, what do you think the right answer is?
There's not a right answer.
No, the right answer of the chat is that do a comparison.
Right.
That's the right answer.
Yeah. No, I mean, that's what I'm saying. Is like it's the right answer is different for everybody because it's based on their personal psychology, their behavior, their abilities to manage their own money or whatever they're doing, or their longevity risk, charitable, all these other factors that you just discussed a minute ago. So again, there's not really a right or wrong answer. It's just making sure you're doing what's right for you.
Yeah, correct. So 43% said take the lump sum right away. And it was actually higher a bit ago. So I'm proud of you guys. Because while that may be the right answer, that is almost always the answer somebody gives right away. Like, I'm taking the lump sum. I don't care what you say. And you know what? We may end up getting there and saying, okay, you know what? You're right. That's great. But you need to run that analysis and you need to kind of take that dispassionate approach and say, okay, what are all the factors that we need to look at? And most times, there's a lot of times that it will be that, yes, lump sum is the best way. Visited with a client, worked with for, almost 20 years now. And he has been at several different oil and gas companies, like you were just mentioning. Mm-hmm. Every one of them had a pension. So some of them, there was not a lot of flexibility. There was not a lump sum option. Most of them were. So the ones that there was not a lump sum option actually happened to be a little bit smaller than the others. So determined, all right, you're going to go ahead and take the pension on this, and here's how you do it. So then we look at all the options they allow, and then you break it down. And then from there, all right, these, you're going to be better off taking the lump sum. Here's why. But we also want to know there can be a time you may have left your job. We want to find out what is the internal rate of return? What are they paying you on a regular basis? But then you alluded to this earlier. Mm-hmm. Also, if you leave it, what is the factor that they have associated with interest rates? So what Lance was mentioning, if interest rates go up, your lump sum payout, if that's what you're looking to do, will decrease because now they can go out, take the risk on themselves, lock in yields at much higher rates, and they're always looking for that little bit of margin to help keep that pension alive, right? Now, on the flip side, if rates are declining, your lump sum will go up.
It's based on the discount future value of your lump sum. Yeah,
correct. But it's going to be tied to interest rates. You need to call them and determine exactly. Look at your plan description documents. They're going to send it out every year, tell you, number one, how well funded it is, and they should tell you exactly what that formula is that they're using. And they're not all created equal. And you need to find out what's the impact. When rates started rising, we had a lot of clients who said, you know what? I wasn't planning on retiring, but I looked at how much, because a lot of times they'll do it on a quarterly basis. Sometimes they do it semi-annually or annually, but most of them do it quarterly.
Yep.
And said, I'm going to work next year for free.
Yep.
Because that's how much, when the rates went up, their lump sum changed. So think about that. Don't just set it and forget it. Even if it's something like, hey, I'm not retiring right now, we'll worry about it later. I'd worry about it now. Now, a lot of you are thinking, hey, well, rates are really going to go down. Maybe. But if it's tied to the 30-year or the 10-year, maybe those don't decline nearly as much. I mean, right now we're seeing that steepening yield curve. So while some of this is, I'm not going to say a guessing game when it comes to this, they're going to tell you what the next month is going, what the next quarter will do, and you have to make a decision. So don't just let it sit. Go ahead and start, especially if you're not there anymore. If you're working, they're likely going to make you keep it. But if you're working somewhere else and it's an old pension, start running that analysis now, because you could leave a lot of money on the table.
You really could, yeah. And again, you got to also be careful. We've talked about this before. A lot of people go, well, I'll take the lump sum and I'll go buy an annuity with it, right? And I've seen a lot of annuity salesmen talk people into doing this. And you got to be really careful of that, because your annuity from the company is based on the current valuation and the discounted future value of those flows of the pension. when you take your lump sum, you're taking a discounted future value today. That's your lump sum payment. So you get less money to go invest in a new annuity, and that sometimes you've got to really run the numbers. And again, I'm not saying it's not possible, but I've seen it work out very few times that if it's done correctly, the private annuity you go buy can yield the same amount of income as your company pension would. Now, again, a lot of people say, well, what if the company goes bankrupt? Pensions are protected. There's a lot of things, ERISA guidelines, a lot of things go into the pension protect you even if the company goes bankrupt. But just be careful, if somebody's selling you an annuity, just make sure it's for the right reasons.
Yeah,
and do the right math, right?
So we're pretty boring. Listen to financial radio, and a while back, listening to a show, and it said, the guy said, you know what? I feel so confident in this product. You could put every dollar you have in it. It's like, whoa, hang on. Now, number one, any of these need to be planned for. In an annuity, if you meet somebody and they say, hey, put every retirement dollar into it, well, that may be okay if you've got a lot of other assets. But remember, anytime you have a pension or annuity, you're basically forfeiting liquidity. And an annuity is going to have a lot of penalties associated with it. So you may say, hey, I've got $1 million pension. I need X amount in retirement assets. I have this much coming in with Social Security. I have other assets that are producing income. Here's my gap. Well, maybe you take $250,000 to bridge that gap, and the remainder you invest. That can be an option. But there was a time when rates went up that you could actually go on the secondary market and you could find annuities that were paying as much or more. But you got to be careful.
Just be careful.
Yeah, well, a lot of times, what I see is somebody calls and says, well, you know what? I found this annuity. It's so great. Look how much it's going to pay. Well, it's a terribly rated company. Like fly-by-night companies. Like, whoa, hang on here. While there are some protections, we don't want to do that. Like, I would rather be safe than sorry. Find somebody that's reputable, that has been around for a very long time and has a very good track record and balance sheet. And that's key with any of those things. There's always going to be something that will promise you more, but if it's too good to be true, it may really be too good to be true.
And unfortunately, it usually turns out to be the case.
Yeah. Way too many times.
Yeah. So, but again, look, if you work for an oil company or a company, it doesn't really matter.
Well, big software companies,
companies,
Microsoft,
too,
lots of those companies have them as well.
Just do the analysis. If you're thinking about retiring or you're close to retirement, it doesn't hurt to run the analysis now and start looking at, okay, what if interest rates do go up by 1 percentage point over the next couple of years, whatever. What does that do to my options? And again, this is just about running options. And this is what Danny and Richard and John do very well, is sit down and just run through all the different scenarios and say, well, here's this scenario, here's this scenario, here's this scenario, which one's right for you? And then again, taking in all these other factors, the psychology, the family, the legacy, all those type of things, and making sure that you're making the right decisions, with your money.
Yeah. And it may not pertain to you. You may not have a pension, but I guarantee you a loved one probably does. There's just not that many of them anymore.
Yeah, nobody I know has a pension.
Nobody you know?
In my family. Yeah. We were all dirt diggers. I mean, we all were out digging ditches, and my dad worked in a versing plant.
You make it sound like you have
Chemical.
a prison crew. It's a family.
We're damn close. I mean, yeah. Talk about my family's like super blue collar.
Yeah.
So, and then there's others in the family that we just won't talk about. Jed Clampett. Anyway,
every family has one.
every cement pond, exactly. Anyway, all right, Danny. Closing comments. Anything?
Nah, I mean, I think number one, just make sure that you understand the options that you have, understand the inner workings of anything that you have with a pension or even an annuity. I mean, I see too many people get into those types of products and then they want to get out and they don't clearly understand how they actually work. So have a very clear understanding. And if the person that you're visiting with can't articulate how it works, the way that you're going to utilize this, the benefits of it, then I'd probably walk away. I mean, make sure that you have a very clear understanding of anything that you're going to do. Go back, do a financial plan. That benefit analysis is only so good if you're looking at it inside just this one scenario. You have to start thinking about all the other implications that it can or cannot have. But that, and then I saw a couple of comments, Lance, in the chat about oh, you're kind of overselling that this isn't a big deal in the market. Right now, the market would dictate that, right? And I'm hearing the same questions and emails, lots of concerns. But I think going back, go sign up for the newsletter. I mean, that's going to show you all the analysis that you need. And at some point, we may want to go through that chart in detail and just show people how to read it.
Sure.
But
yeah, I mean, we can. And again, there's a lot of information in the newsletter that again we don't publish anywhere else. And so if you only read our newsletter every week, you're gonna get more out of that than you do out of the other stuff that we write. So again, I just encourage you to sign up for it. We email it directly to you on Saturdays. Give you something to read over the weekends, but we go through markets. We give you technical levels for the markets, things to watch out for, kind of all those type of things. And those are in the newsletter every week.
It's only $200 a newsletter, so.
Exactly. No, it's free. And speaking of...
it's free, so you should go sign up.
You should go sign up because it's free. And while you're there, also there's a banner on the website for the Economic Summit that's coming up in January. So again, I encourage you to try to get your seats early because again, we're going to be covering artificial intelligence, the future of digital assets. We're going to cover investing, the bond market. We've got a lot of Ed Slott's coming to talk all about retirement planning. So there's going to be a whole lot of information. It's a jam-packed day. We're going to feed you. It's a nice hotel, so you'll enjoy it. It's here in Houston. So if you're out of town, you'll need to fly in, but we'd love to see you. We've got a block of rooms available for you as well, discounted rates. So, if you're going to fly in for the conference, love to have you here.
And I don't think Lance is as excited about Ed Slott because he keeps leaving him out. because
I just said he's going to be there. He's America's retirement planner.
Correct.
I'm
very, very proud of you. And so Richard and I will be answering questions with Ed Slott. Ed is phenomenal. And so he's the one who goes through all legislation. He writes a lot of books on it. So questions on taxation and retirement, he is the guru. So we're really excited to have him.
Exactly. So it'll be a really good conference. So again, get your tickets early because again, they're going to sell out fast. It is January the 17th. Yes. So it's coming up quick. So get your tickets now. It's all online. All right. That wraps up the show for the day. Thank y'all so much. Be sure and like and subscribe to the channel. Certainly helps us. We've got some great interviews coming out for you next week as well. So our continuing interview series editions, we've got Garrett Baldwin, Parker White, Peter Atwater, some great stuff next week. So again, hang out next week on the YouTube channel. And again, it's Thanksgiving week as well. So it's even going to be better stuff. So anyway, be sure to like, subscribe to the channel. Those likes and subscribes help us continue to get better interviewees here on the show to give y'all better information. That certainly helps us a lot. And we appreciate it. All right. Have a great day. See you back here tomorrow with Michael Leibowitz for the next edition of the Real Investment Show. See ya.